HRD. All right, let's now get into a deep dive and a detailed conversation with Mihir Vora and understand the thought behind coming with a new mutual fund. What are his ideas? How is he planning to differentiate? Every investor, in a sense, follows a simple philosophy, which is that you buy good business at a reasonable time and you stick to that business for a long period of time to create wealth. So if thought process for all investors is simple, then why are portfolios different? And why in this kind of a market, which is now a crowded market with almost more than 24 AMCs, how is Trust Mutual Fund planning to differentiate itself? Mihir, fantastic to have you on ET Now. Thank you for joining us. You're coming with a mutual fund when markets are at an all-time high. The general view in the market is that valuations are also looking slightly stretched and above historical valuations. Normally, you want to raise money when there is gloom and doom, when there is value in the market. What's the thought behind coming with a mutual fund now at the time when Sensex is at 70,000, 75,000 and Nifty is at 22,000?
First of all, thank you, Nikunj, for having me on the show. Always a pleasure to be here. To launch a new business, it's sometimes more about getting the right team in place rather than timing. So we were making sure that we have the right team in place. I joined last year, built my team, and now we have, I think, the best of the high quality team in place. Now we are ready to go. It just so happens that the markets have done so well, and there are two ways of looking at it, in the sense that when the market is doing so well, people are open to new ideas. People are willing to look at new strategies. So we are actually getting a good response on our roadshows because there's a bit of a freshness and newness in what we are presenting. So there are pros and cons. I think the timing is not too bad, and as we say, timing the market is less important than time spent in the market. So we are here to build the business over a long period of time with the right quality and the right investment strategy. And I think there's no better time to start than now.
How are you planning to differentiate? Because the AMC market is now a crowded market, and if that was not enough, you got PMS and plethora of PMS now, which pretty much are giving you a differentiated strategy.
Certainly. See, for any fund manager or asset management company, whether it's on the PMS side or mutual fund or insurance or whatever, what matters is three things in my view. One is, who are the promoters? What is the background of the promoters? Second is, who are the fund managers? And third is, what is the investment strategy and philosophy? I believe we have something unique in all the three aspects. The promoters, Utpal and Nipa Seth, are giants in their own respective fields. Utpal in equities, Nipa in fixed income. I come with 30 years of experience across asset classes, managing very large sums of institutional money. And I've done it across different mandates. I've done it in mutual funds for almost 18 years. I've done it for sovereign wealth funds, which is the government of Abu Dhabi, sovereign wealth fund. And I've done it for the previous 9 years in a large insurance company. And that included all asset classes: equity, fixed income, real estate, InvITs, REITs, AIFs. So I think with my kind of experience, with the promoter background that we have, investors should get the comfort that this institution, which we are building, is here for the long term. We have seen cycles. The promoters and myself are fully committed for the long term, and we will not get swayed by short-term things, because we've seen in our careers, 35 years, Utpal and Nipa, 30 years me. So we know that markets can be volatile. We know that markets can be even unforgiving at points in time, but we will not get swayed by that. A lot of time we have seen that when there are performance patches which are not so great, we've seen some houses or some fund managers, they either change their style or they change their strategy. We know what we stand for. We know very clearly what our investment philosophy is, and we will run it truthfully. And we know that it works. So for us, it's not a question of whether it will or not. It's only a question of sticking to the right strategy.
The mutual business is never an absolute performance business. It's relative. You have to beat the benchmark, and you have to do better than the competition. So what's the benchmark you're setting for yourself?
Benchmark is the NSE 500. And our strategy is to run a focused portfolio of about 40 to 60 stocks, right? About 15 stocks will be, what we call stocks which, in our view, can become potential goals. Because I'd ideally like to have all 50 stocks along that strategy, but it's not easy to find such stocks with such high conviction levels. So about 15 out of those 50 stocks will be stocks where we have that kind of conviction, and the remaining stocks will be GARV, with growth at reasonable valuations kind of an approach. But clearly we are not looking to hug the benchmark. We are here to take active bet against the benchmark across large cap, mid cap and small cap. So we are market cap agnostic, sector agnostic. We just want the best stocks in the portfolio, whichever bucket they come from.
Okay, now why did Mihir use the word gorilla? And here's an interesting graphic which would come on your screen, which is that in investment terminology, when you look at gorilla, well, what are gorillas? Gorillas are rare. You rarely find a gorilla in a jungle. They are dominant and they live long, unlike the monkey tribe. Now, good companies are rare to find. There are very few companies which will survive the ups and downs of disruption and market volatility and macro uncertainty. And if they live long, they can create a lot of wealth. So that is the underlying thesis behind gorilla investing.
Absolutely.
Okay, so let's understand first, why are good companies hard to find? Because if India opportunity is so great, everybody should do well.
Absolutely. So that's a very pertinent question, and gorilla investing actually is kind of a personification of our investment style, which is to find stocks with high terminal value. We call it terminal value investing.
What is terminal value?
Exactly. So, normally in markets like India is anyway a high growth market. We grow GDP at 6-7%, so nominal GDP grows at 11-12%, right? And within that, the corporate sector, the organized sector is growing faster, so say 12-13-14%. But even within that, there are always segments and sub-segments which grow faster than even 12-15%, right? What is typically happening, and this is a mental thing that all analysts and fund managers have, that it's easier to predict for the short term. So we look at the past few years of track record or good growth. We meet the company, we know the company's business plans for the next few years, and it's easy to predict or at least forecast some numbers for the next 2, 3, 4, 5 years. Typically beyond 10 years, nobody forecasts. So in high stocks and sectors, what happens is you would predict 30-40% growth for the next 3 years. Then you're not sure, so you taper it down to 25%, then maybe 20%, 15%. And beyond the 10th year, it's just not visible. So you just say that it will grow at GDP levels. So typically...
Like IT. 2000 growth 100%.
Absolutely.
Came down to 50. When they spoke about 30% growth, it was called as a profit warning. And today they are growing at a rate which is lower than India's GDP.
Absolutely.
Nominal GDP.
Nominal GDP, absolutely. So that's what typically happens. That's the mindset, that the further you go, the less clear it becomes. And then, so you assume conservative numbers, 5-7% GDP growth kind of numbers. What happens in high growth stocks and segments is that this growth rate beyond the 10th year that you're assuming does not end at 7%. It stays high, or even in some cases even accelerates. Okay. So
for academic purposes, can you enumerate that with an example? We're discussing not a stock recommendation here,
absolutely,
but perhaps an idea which can just go well with the audience.
Absolutely. So let's say the largest jewelry company in the country, promoted by the most respected business house, which was into watches earlier, and in the 90s they diversified into jewelry manufacturing.
The company which is known as RJ's famous stock.
Yeah. Okay. So this company in 2006, we have data. We have done a lot of studies since 2006. In 2006, this company had a profit of approximately 80 crores, right? And the market cap was approximately, give or take, 4,000 crores. At that time, also, it had already become a high growth company. It was growing at 20, 30, 35%. So it was a 80 crore profit company, 4,000 crore market cap, and at a fast pace. So typically, what the framework that we use, we would assume a few more good years of 30-35% growth, 20-25% growth, then 10-15% growth, and beyond 10th year, let's say 7%, which is kind of like GDP growth. So by that logic, today, the profits of that company should have been approximately 1,300 crores, right? Today, for FY24, the profits of that company are probably closer to 4,000 crores, right? So our model was so conservative that we got today's profits wrong by almost 3 times. It's even more stark in the market cap sense. I told you the market cap was approximately 4,000 crores and the profits were approximately 80 crores. So at that time, the PE was 50, right? Today, I told you the profits are closer to 4,000 crores.
Yes.
So actually the PE was 1, not 50, right? Yes. Because the profits went up by 50 times.
You best in this mutual fund or in this scheme which you can hold for 10 years. Is that what you're indicating?
No, that's where the biggest misunderstanding happens.
Okay.
It's that as I told you, you would have thought in 2006 the PE is 50.
Okay.
Even I would have thought the same because we did not have the vision of 4,000 crores profits. Which means that you would probably have not bought the stock because we would have found it expensive.
Okay.
Right? But if somebody had a view that this stock is blank sheet in the largest consumer segment, which is jewelry in the country, with a brand name like the sponsors, and virtually no competition in the branded space at that point in time. Even now, 80% is still unorganized. Then, if one would have taken some vision and predicted some kind of profit, even if you are wrong by 100%, it still would have been a huge pathway. So that's where the difference is. So the stock made money in the first 10 years, which is the projected period, but it continued to compound even after that. So the CAGR for the stock from 2006 to 16 was 8x, almost a 23% CAGR. But from 16 to 23, it again grew by another 7.5 times.
Wow.
So it became a 60 bagger. So first of all, by having that bigger terminal growth rate in mind, you would have actually ended up buying a stock instead of ignoring it and treating it as an expensive stock.
So if I break it for
and you would have held on to it because you're not buying it for 100% gains or 200%, because you still have a view about the long-term growth rate.
So just to break it for viewers, what you're saying is that you are in the quest of identifying that how high the peak of a mountain is. When you're at the bottom of the mountain, you cannot see the peak. It could be clouded, it could be snowy.
Absolutely.
You don't know how high the peak is, but you're trying to understand that how strong the runway, pathway or the peak is. That is terminal value investing.
Absolutely.
At the current juncture, can you identify some potential themes or mega trends where you see there is a 10 to 15 year visibility? Have you done your homework on it? Is that true?
Absolutely. So there are three themes that we like, basically, and these are mega themes or mega trends, as you could call them, for India. First is premium consumption. Okay. All premium services and goods will grow at rates much faster than what we think they will.
What is premium consumption? What is the ticket value according to you?
It's the segment, I would say, not the ticket value. Say travel and leisure, hotels, high-end cars, higher-end bikes. You can say a lot of high-end electronics. Okay. All that consumption basket, high-end
luxury
premium real estate. Exactly, premium real estate. All segments will grow at a rate much faster, and the logic is simple. First of all, the pyramid is shrinking at the bottom and growing at the demographic pyramid, income pyramid is growing at the top much faster.
Urbanization has started.
Urbanization, higher income levels. But the numbers, if you just put in perspective, can be very stark. And when we talk about 10, 20 year runway, you need to keep those big numbers in mind. Between 2005 and 2018, or 2006 and 2018, the number of households with an income level of more than 30 lakhs grew by 8 times.
Okay.
It was about 10 lakh households. It became 80 lakh households. 8x, right? That number from 80 lakhs is going to 3 crores by 2030.
Another 80 times.
80 lakhs to 3 crores.
80 lakh to 3 crores.
Another 4 times.
Okay, another 4 times. Okay.
Another 4 times. So it has already grown.
And the base is 30 lakhs.
And the base is now, the 30 lakh income levels.
Income level.
Income level, absolutely, right? Similarly, which is the highest end, with the top affluent. Upper middle class will grow by 3 times.
Okay.
Right? Similarly. So 4x increase in the highest level income level segment, 3 times increase in the upper middle class, and the bottom shrinking. So this will lead to a long runway of premium consumption.
Okay. Premium consumption, just to break it for our viewers, that India grows, capital will grow, Indians will consume more, whether it is travel, whether it is leisure, whether it is experience, or whether it is perhaps buying a better car, a better mobile phone, or better real estate.
Higher end car, higher end mobile phone.
So that's one trend.
Absolutely. Jewelry, eating out.
Okay. What is the second mega trend?
Second mega trend is linked to manufacturing and demographic, which is the increase in the working population.
Okay.
Right? From now till foreseeable future, 10, 20, 30 years, India is the only large country in the world which will grow its working age population. We are going to add 80 to 1 crore working age population people every year for the foreseeable future. China has already peaked out. China's working age population is reducing. Japan anyway peaked out much earlier. Europe has peaked out much earlier. This will be flat. Okay. So the only labor supply in the world will come from India, and we can already see that. And apart from the fact that China is a geopolitical question mark, people are getting worried about China. This also, demographics is a big factor to consider. So manufacturing has to come to India. whether we invite it or not. So it will come. And then within that, if you look at the relative size, the total size of manufacturing in India is 0.5 trillion, right? The world manufacturing GDP per year is 11 trillion.
Okay.
So we are just 5% of the world, and we will add 20% of the working age population for the foreseeable future.
But will everything in manufacturing do well? Because manufacturing starts from, cars to even electronic phones, even pharma is manufacturing, everything is part of manufacturing.
Absolutely.
What will do well in manufacturing?
So, for example, in cars, we already have a critical mass of ecosystem because we've done it for the last 3 years now. That cars and two-wheelers ecosystem is very well developed. Electronics, we have barely scratched the surface. Defense manufacturing, we have barely scratched the surface. So there are many segments, renewables, for example, we have barely semiconductors, we have barely scratched the surface. So these are the segments which will have a much longer runway. Auto will do well. Pharma, we have, we are the number one in terms of volume manufacturing. Pharma, chemicals, we are anyway doing well. These new segments can have a much higher growth rate for much longer than we think.
What about risk of automation? Let's say 10 years ago, if I would have made a template for Indian IT sector, no one would have thought that this sector would see a single-digit growth. No one thought that AI, in a sense, will have a basic problem in terms of absorbing the coders.
Absolutely.
So automation and technology has changed the way how IT would do well. Why do you think that cannot happen in manufacturing?
So, for example, even to manufacture those robots, you need people.
Okay.
Right? So there is, wheels with wheels. And net is that you can't do away with labor completely. Textiles, for example, it is a labor-intensive job. Of course, you need people to man the machine. So maybe you'll upgrade the skill set requirements, but that doesn't mean you do away with people entirely. And especially given the fact that elsewhere the labor pool is shrinking. So you might just need a robots just to compensate for the shrinking labor pool, if nothing else.
Okay. What's the trend number third? We've discussed per capita, we've discussed manufacturing. Trend number third.
So first is premium consumption, and that includes financialization of savings. Okay. So that means that segments, of course, banks have been good. We are positive on banks, etc. NBFC is well known. But when you are talking about premiumization and higher income levels, it means that you probably see capital market segments like brokers, AMCs, insurance, wealth managers, retail financing. Those segments can grow faster than the rest of the economy, right? So premiumization and financialization of savings is one theme. Physical asset creation is another one, which manufacturing is a big part of that. Infrastructure, because is chicken and egg, right? For manufacturing, you need infra. But it happens that if you create infra, then manufacturing, is attracted and it comes automatically. And third offshoot, of course, of all this real estate. You need commercial property, industrial property, and household property. In my mind, I'm very clear that our target growth of GDP of 7% growth cannot happen without physical asset creation. So if we do not have our manufacturing and infra and real estate right, we can probably not grow beyond 5.5%. That 1.5% extra has to come from fixed asset creation. Even today, China is creating gross fixed asset per year of $7 trillion. They are creating fixed assets of $1 trillion. Yeah. So every year, we don't grow, the Chinese lead on physical assets is growing. So we have a long way to catch up, and this can have a, that 10, 20, 30-year runway. These are kind of things that we should look for when we are talking about the longevity of the runway. And the third one is, the third theme that we are talking about is technological disruption and digitization. So this whole ecosystem that we have developed of Aadhaar, UPI, Jan-Dhan, mobile has had so much implications, so many implications across categories. Delivery of government services, subsidies, healthcare, etc. is become much more efficient, for helping many more people directly, lifting them out of poverty directly, indirectly. The fact that now you have so many fintechs and B2B, B2C companies disrupting existing business models and creating new business models which did not exist. And we only seen, I think, the top of the iceberg in terms of a few listings in the last 2-3 years, which have, they listed at a premium, went down, and now again are coming back
the
to
consumer tech and the fintech companies.
Consumer tech, fintech, even B2B companies will come. Because I think this whole ecosystem is below the surface. We've just seen the tip of the iceberg. There are like hundreds and thousands of startups which have been funded, and I'm sure a lot of them keep coming. There are hundreds of drone companies in India. I didn't even realize how many drone companies are in India till I started doing a study. There are literally hundreds of drone manufacturers, robotics manufacturers. All those will come to listing. So technology and disruption is another big theme that should grow faster than the rest of the market.
So a lot of folks say, okay, railway stocks are overbought, defense stocks are priced fiction. There are hundreds of drone companies. It's a crowded trade. You think the defense as a theme still has a long way to go?
Oh, certainly. Oh, I mean, don't get me started on that. You know, our entire defense spending is probably 2.5 lakh crores, 3 lakh crores. We're talking about $40 billion, $50 billion, which will probably go to $60, $80 billion in the next 5-7 years. This was all imported mostly, right? 80% imported, 70% imported. The government has given a path to 70-80% Atmanirbharta, indigenization, and item by item, they have laid out the plan as to this item will not be imported from this year onwards. It's a clear path. So our local manufacturing, as of now, after many years, has come to 1,20,000 crores, right? And 3 lakh is the spending, which will anyway go to 6 lakh crores because 8-10% CAGR happens for spending in any case. So this 1 lakh crore can anyway go to 4 to 5 lakh crores in the next 5-7 years, which is the local substitution of local procurement. What also happened is that forever, we did not allow private sector participation. So there was no sophisticated private sector ecosystem of supply chain. But now that has come in. In the last 4-5 years, we are seeing public-private participation increase. All the PSUs are also sourcing a lot more from the private sector because they need to ramp up. Everything can't be done by the public sector. We've seen in sector after sector, whether it's auto, which started in the 80s, pharma again started in the 80s, IT. Wherever private sector comes in, ultimately that ecosystem develops, we become efficient and we become world-class competitive. We haven't even scratched the surface of exports. The whole export market, our 3 lakh crores is what I said, approximately $50 billion. The trade in defense is $1 trillion, which we haven't even touched.
We don't talk about it, but after financials, I think it would be the largest, biggest industry in the world. It's just that numbers are hard to document.
Exactly.
Okay. Now, when you say terminal value, one core pillar of terminal value is leadership. And it's easy to identify leadership stocks or leadership companies in any sector. Banks, HDFC Bank. Food delivery, Zomato. Jewelry, Titan. Cement, Ultratech. So would you be buying these leadership stocks wherever mega trends are?
We are looking at existing and potential leaders. Stocks which can become leaders in their respective field, And, it's a very good question that you asked. The one big example that we discussed, for a long period of the jewelry company, that was a leader to start. So the misconception happens if you're looking at multi-baggers, you need to get micro caps or small caps. No, that's not the point. We have example after example of companies in 2006, the largest biscuits company, for example, the largest home
paint company.
So all the companies were large to start with, but they continued to compound it. So it's across the board. There is no bias towards market cap. There is no bias towards any sector. Leaders can emerge from anywhere, or existing leaders themselves can continue to compound.
Will you shy away from buying IPOs? Would you wait for companies which have a 5-7 year track record? Then only will they qualify as part of the portfolio. A lot of fund managers follow that. I mean, Nalanda, we would look at least a 5 to 7 year history below before it qualifies the cut for us to be part of their portfolio.
Sure.
Would you follow that kind of a rule?
No. If I'm able to give a valuation to the company, then I would definitely consider it. So if I have enough data for the future or enough visibility or a view on the future, whether it's some sort of target addressable market or the company's growth plans, etc., then I don't mind putting some value to it and then check whether the IPO price is worth it or not. It does not matter to me whether the company has had a profitability record for the last 2-3 years or not, provided I have a visibility for the future.
Will tactical trades be part of this portfolio? Every fund manager has to identify tactical trades. It could be metals, it could be IT, it for that matter could be PSU banks. What about the tactical allocation of this portfolio?
Tactical, we would like to avoid as far as possible. But, sometimes, as you rightly mentioned, for me, for example, oil marketing companies, they will never be strategic plays. But at some point in time, they become so cheap that you can see that there is a 50-80% upside. And we've seen that, pop happen from time to time. Commodities, again, I don't think commodities are a strategic buy. But if China, for example, right now is coming back and there is a increase in demand, the fact that these commodities were beaten down for so long may mean a tactical trade. So maybe 5-10% of the portfolio can be in those areas, but not as a conscious decision.
Your fund is right now open for subscription, NFO is on, and soon it will declare its public NAV. So what will the portfolio be like when it will be open for public scrutiny?
Yeah. So I think the 3 themes that we have identified, most of them, if you notice,
But you would start.
domestic
You
names.
would be fully invested. It's not that you're waiting. Not that you're raising cash and waiting for a market to decline to deploy it.
Not no, that's not a cash call that we would like to do, because anyway, it's closing on the 19th, and the first NAV should be published towards the end of the month. So we are not really looking to time the market. As long as we are comfortable with the stocks that we wanted, we'll probably go ahead. So my guess is 2 to 4 weeks we should be able to deploy the funds.
Okay. The charm of Trust Mutual Fund are the promoters. Utpal Seth, Nipa Seth, husband and wife. But like you said, they are really masters of their craft. Utpal in PN and equity, Nipa when it comes to debt. What is the brief from the promoters? Run it like what we've done so successfully, or run it differently?
Run it to build a long-term institution. We are in for the long term. We want to do the right things the right way. And we are PE funded or VC funded. There is no exit strategy required for 5 years, 7, 9 years. As long as we are following our core principles, and I think we have very clearly defined our investment philosophy, we'll continue to do that, because we are very confident it's worked for us. It's also my inherent style. My other fund manager Akash Mangani, we are all growth investors, and we do genuinely believe in this style. And short-term performance they will not matter to us, as long as we are confident that we are sticking to our core philosophy.
We typically, when schemes they start, and especially in mutual funds they start, they have options to invest in small and mid-cap stocks. But as they grow, I see the portfolios change. If you look at some of your peer AMCs who had very recent beginnings, the portfolio 3 years ago versus now has changed completely. And when I ask them why, your investment philosophy has changed, they say no, our size has changed.
Correct.
We cannot invest in those stocks in a meaningful manner. Are you likely to follow the same today? Because when you're raising capital, you would be starting at a small base.
Smaller base.
You would have different names to invest in as you grow. It could be compulsion, it could be risk management. The portfolio could change completely in terms of names.
I would like to have a problem, to such a size that I start facing that problem. But in the initial couple of years, I don't see that problem happening, frankly speaking, because this style is not a high churn style. Right? We're not going to churn the portfolio. We're going to take active bets, which means our bets will be away from the benchmark. We don't have to hug the benchmark, but does not mean that we trade very actively.
If you're running...
If you like this video, then like, share and subscribe to ET Now.